Welcome back, everybody. Doug Burson, CPA, PFS here, and I've been in the industry for 25 years. Now go ahead, subscribe now, because you have finally found a channel that's going to shoot it to you straight on all your tax, business, and investing questions. Come on, click the button and help me get to 1,000 subs. Now the following video is edited down from a YouTube live event we recently did, and it's like getting a set with your CPA to find out what you should do this year without having to pay him, and I know you like that. So if you have any tax questions, drop them down below and I will personally look at them, and let's get started. One of the things that we've been worried about for the last several years is if the Tax Cuts and Jobs Act expires, what's that going to do to us? Because it's set to expire the end of next year. Because of how the election occurred, and I'm not going to get into politics, we're just going to stick with facts here, most of that is probably going to stay the way it was. We don't know exactly. We're going to have to watch that close, but stay tuned next year as those things come out. I'll keep you up to date. But one of the big ones we were worried about was the estate tax. I think that one is probably going to be, I think that one's going to be safe. But there was a lot of tax planning strategies that we were doing based on that. That one we're going to have to wait and see. But there's a whole lot there. And just stay tuned. I'll go through with that. But really, it's going to have to go through reconciliation. That's going to require them to work on a budget, which isn't their favorite thing. So who knows what's going to really happen. But I think most of that will probably stay the way it is. But I'll keep you up to date on that. All right, moving on. The next thing it said in this letter is it talks about the EVs, the credit for the your Teslas and things like that. This one's important because there's a $7,500 credit, but unfortunately, a lot of people have been told they qualify, and they may or they may not because there's thresholds there. If you make too much money, you may not get it. Or if you don't have any tax, and that's one that can really hurt somebody, is they think they're getting a $7,500 credit, but they only had $3,000 of tax. It's not going to work. And so if you got one of those Teslas and you think you're getting a credit, or a Ford, or whatever it is that qualified, I don't really care. You may want to make sure, go look at the AGI limits. I don't have that off the top of my head, and make sure that's going to be covered, because if not, you may come in here for taxes in March and April and think you're okay, and you didn't even qualify for the credit. Another one that I'm really worried about is a lot of the dealers in 24 were allowing you to apply that $7,500 credit to the purchase price. It's the same issue. If you didn't have the parameters for your taxes for it to qualify, you're going to be surprised, and you may even owe it back. So if that's you, just go look at the AGI limits. I think it's, oh shoot, I should have looked this up. It's right around 300,000. I don't know, but you can look that up pretty quick. Just because you got it applied towards the car when you bought it doesn't mean you're off the hook on paying it back, and we have to reconcile that on the tax return. So that's something I wanted to cover. If you got a lease, though, the lease is actually different, because when they applied that towards your purchase price as a lease, you aren't the one who really got the credit. That credit actually went to the leasing company. So if you did it that way, you're okay. That could lead to another strategy as far as how to buy one of these. If you don't qualify because your income's too high or too low, well, let me scratch that. If your income's too low, don't be going and buying a Tesla. You can't afford it. But, well, that's not true. Maybe you had a net operating loss or whatever, but you understand what I'm saying. Make wise decisions. However, if you don't qualify because your income is too high, maybe the lease does make sense for you, but I'd want to really look at the numbers and all that. So that's something to think about on those leases. Next thing on this list, that I thought was worth talking about, the NIT tax. That doesn't affect most people. Long-term capital gains rates. Now this one, we still currently have a 0% rate if you're in the 15% or lower tax bracket. So if you're somebody whose income is going to stay in that 12% bracket or 15% bracket, and you have some stuff that's appreciated, this could be a good time for you to sell it and take advantage of that 0% rate. Now, since the Tax Cuts and Jobs Act, probably a lot of that will get extended. It may not be as critical, but still take advantage of it. If we've got that bandwidth there of tax-free gains, let's make sure we take take that opportunity. So I want you guys to know about that. 20% rate, that kicks in for people that are usually around 500,000 of income. So if your income is higher, be aware you may not be in a 15%. It could be 20. But also make sure we're taking advantage of harvesting any losses. Harvesting losses is something a lot of people overlook. So if you've had a big gain, you want to make sure that we take any of these losers that aren't working, and maybe you just sell them for 31 days and bring them back. We don't want to get caught with wash loss sale rules, but you could actually offset that. That's also another good strategy that people don't think about if you have a business or if you have some stocks that have appreciated and you're going to need to sell them. You may want to talk to your financial advisor about putting in some not wash loss, sorry about that, but a loss harvesting strategy where they can intentionally set your stuff up to start grabbing losses on purpose to offset gains. How does that work? Well, the S&P 500 or whatever you're invested in always has winners and losers. If we take advantage of that, we can have those ones that are losing, sell them, wait 31 days to avoid the wash loss rules, rebuy them. We've captured that loss, and yet we still own the stock. So when we sell something else that has a gain, we've grabbed a loss to help lower that taxes. And that can be very powerful, especially if we do it on purpose for multiple years in a row to help offset something that maybe you're going to sell in the future. So that's something a lot of people probably haven't thought about, but it really is a powerful tool when used the right way. And there are companies out there that specialize in setting up portfolios to do that. If you don't know anybody, I have some people that do that really well and would be glad to help you on that. Let's see, what else was on this list? The truth is, a lot of this is, like I said, you guys get it and you're like, this doesn't apply to me. Who cares? And so that's why we're doing it. Roth IRAs, getting back to that same tax bracket section. If we have bandwidth in our tax bracket, say you're in the 12% bracket, or maybe even the 22, I mean, that's more plenty, but maybe in the 22, but you still got 20 or 30,000 left in that bracket. This may be a good year for you to go ahead and start doing that Roth conversion and paying taxes at that lower rate. A lot of us don't like to think about paying taxes, but the truth is taxes are at a discount right now. We are at all-time low tax rates. And I know when I'm sitting across the table from a client and I say that, they look at me like I'm crazy, but it's true. Our tax rates are some of the best that we will probably ever see in our lifetime. So if you have room left in that tax bracket, it may make a lot of sense for you to go ahead and make that conversion. Work with your financial planner, work with your CPA, and let's save some taxes. Once again, if you guys have any questions on any of this stuff, go ahead and post it. I'll be glad to answer your questions. That's really the main reason I'm here, is to answer any questions you guys may have. Let's see, what's the next thing on this letter that you aren't reading? Don't care about that. Don't care about that. All right, there's one there that's in this letter that I really struggled with, but I went ahead and left it in there to talk about. And that was the concept of expenses. If you have some expenses that would be deductible on your tax return, but you don't have the cash, you could potentially go ahead and use your credit card and pay for the taxes with that, not the taxes, pay for the expenses, because once you put something on a tax return, on a credit card, it's deductible right then, even if you don't pay it till next month. Now, I don't like it because most of you will start getting into problems with debt. Not a good plan. But there are instances where it could make a lot of sense. Let's see, what else do I have here? Kind of finish up this section. RMDs. Actually, that's a good one. RMDs are now to 73. But one thing on the RMDs that if you turn 73, you have to get that out by April the next year. I would caution you about waiting till next year. And the reason is that means you could have 2 RMDs in 1 year, which could cause you to have tax implications that you haven't thought about. Maybe that's going to push you up into IRMA, where you're going to have to pay more on Medicare. Maybe that's going to cause more of your Social Security to be taxed. So you may want to make sure you get that RMD in this year. In a lot of cases, that's actually going to make the most sense. Even though you can wait till April, get it in. Once RMDs start, you have to take it every year. You can't push that off. However, there is something called a qualified charitable distribution. I've talked about that in the past for you guys, and I really want to make sure you take advantage of that because I love QCDs. They're wonderful. QCDs are wonderful. And the reason why is the standard deduction so high, most of you don't get to itemize anymore. And so we take money out of our IRA, we give it to our church or whoever it is that you want to donate to that's a 501c, and then we pay taxes on that money. If you do it through a QCD, it goes straight from the IRA, straight to the charity, and it never gets taxed. And so it's a way of getting that deduction back that we lost when they raised the itemized deductions back in 2018. Now, there was a guy that said, I have a question here on what do I think of donating appreciated stock for charitable contributions? I think in the right situation, that can be a wonderful plan. So think about this. Let's say you bought stock in the 80s, really cheap, and now it's appreciated. If you wanted to make that donation to the charity, you would have to sell the stock, pay a ton of tax on that gain, and that's going to give you less to give to the charity. But if you donate it to the charity, you get to donate at fair market value, and then the charity can choose to sell it. And because they're a nonprofit, they won't pay taxes on it. So it's a win-win for both of you. It's a nice little thing that is set up in there. But make sure it's a charity you believe in. I don't like using tax laws just to try to save taxes, and make sure it's something you believe in. You want to support a group that really aligns with your beliefs and your goals. Don't do something just for the tax purpose. But there's also some really great opportunities in Missouri where you can donate to charities. And there's one, I was talking to a client yesterday, and they donated to 2 different charities, and they're getting a 50% credit on their state tax return for those donations. Plus, they get to deduct it at the federal level. So if you're in a 30% bracket and you got a 50% credit at the state level, that's 80%. You donated $1,000 and it only really cost you $200. That's awesome, as long as A, you have enough tax on the state level to absorb the credit, and 2, it's a charity you believe in. And there's some really good charities in Missouri that can do that. Not all states have that, but it's a very nice thing that we can do here. And for the right charity, it actually, you're helping them out, and it's almost free. I've seen some in Missouri that have been as high as 70% credits in the past. You do that and get a 30% deduction. It didn't cost you anything. And instead of giving the money to the IRS, who may or may not spend it wisely, you've given it to somebody who you believe is doing good things. And so I like it a lot. Rollover distributions from a retirement plan. I think most people understand that when you retire. I will make a comment on that. Try to make sure when you retire that you roll the money straight into the IRA if it's the best thing for you to do. Don't just assume it is, but if it's the best thing, and a lot of times it is, make sure you go straight from trustee to trustee. Because if you don't, things can go haywire. And if you don't get that money back into that IRA within 60 days, it can be taxable. Plus, you're only allowed to do that once per rolling year. It's not is it a rolling year or a calendar year? I have to double check that. But either way, if that's you, make sure you check that. But you can only take money out and then physically do a rollover once a year. And so if you do the trustee to trustee, you can do that as many times as you want, and you won't get in trouble. There's a court case a few years back from a big actor. He made a mistake and he missed it by a day, took it all the way up in this court system, and he lost. There is no mercy on that 61 days. You have to get it in within 60 or it's taxable. And that could be a horrible, horrible mistake. So make sure you just do trustee to trustee. That's all I really want to say there. Now this one's actually new, and it's not for 24, but I wanted you guys to know that there's, I don't know, you call it a super catch up. But if you're between 60 and 63, 60 and 63, next year, instead of a $7,500 catch up, you can do a $10,000 catch up into your retirement account, which allows you to really, I think that's your IRA actually, but you can really supercharge how much money you're getting into your retirement before you retire. So that's something coming for next year. That's not this year, but that's next year. I want you guys to know about it. Another one that was really cool that happened is 529 plans. You put all that money into the 529 and then it didn't all get used. Maybe the kid did a really good job in school, got scholarships. Maybe they didn't go to school, whatever, but there's excess left over. They're now allowed to do a rollover on that. And I believe I'd have to double check that. I think it's about $50,000. But that's a really nice thing, so that money that goes into that retirement doesn't have to get taxed if they don't use it. It can actually go into their Roth. So think about this. We've done this for a child or a grandchild or whatever. They did really good. It's leftover. Imagine if a kid could roll over 50,000 into a Roth, and then we know money doubles every 7 to 10 years, depending on rates and how the market does. What kind of a position you're putting your child or grandchild in when they get to 60 years old? The nest egg that they could have is phenomenal. So I think that's a really nice change they did. I think that's a great thing. RMDs move up to 73. I think I talked about that earlier. We covered QCDs. Those are awesome. I didn't give you the cap. The cap's $105,000. So you can do up to $105,000 into QCDs. That's that qualified charitable distribution. Your financial advisor should know what you're talking about when you ask. If they don't, find a different advisor. I don't know what to say about that. Find a different advisor. That's getting more complex. That's very specific. I'd want to work with you one-on-one on that. Decreasing AGI, that's one that makes more sense to people. We are December 12th. Especially if you're a business owner, you have an opportunity over the next couple of weeks, if you had a big profit and it makes sense, don't just buy stuff to buy stuff, to go buy a large piece of equipment to bring that tax down if necessary and use a Section 179. Maybe buy a new heavy-duty truck. We get a big deduction there, and it could save you a lot of money. But don't buy it just for taxes, because a lot of people think it's dollar for dollar, and that's stupid. If you go and buy a truck and spend $60,000, so what if I get a 30% tax deduction? I'm still out the rest of the money. I only got a 30%, right? 30%. So you've got $20,000 in tax savings, but the $40,000 is gone. So we only want to do this when it makes sense. Don't do stuff, they call it, don't let the tax tail wag the dog. That's how it goes. Don't do that. It needs to make sense. You're going to have a lot more money later on in life if you only buy what you need, but take advantage of the laws that are there for us. Wash loss sales, I think I talked about that already. If you sell something for a loss and then you rebuy it in less than 30 days, you don't get that loss. And that can be very frustrating for somebody who sold something for a loss. They thought they were okay, and then they invested in basically the same thing, and they lost it. Big mistake. I see it every year. Most of the time it's small, but I have seen somebody lose $30,000, $40,000, $50,000 deduction in 1 year because they weren't paying attention to the dates. So don't let the wash loss sales creep up on you. HSAs. I love HSAs. HSA is just another way to get an IRA going, especially if you're healthy, but you have to have a high deductible health plan. But I love HSAs. If your company has that set up, or if you have a high deductible plan and they don't have an HSA, this is a great way to lower your taxes and be saving, and also have money set aside if something does come up. So HSAs are wonderful. $4,150 for single, $8,300 if you're married. So those are great, and they're actually like the IRA. They also have a catch-up, so you can do an additional $1,000 catch-up if you're over 50 years old. So that's really nice. What else is in here? Accelerating expenses, medical expenses. It's not something I see much anymore because of the standard deductions being so high. So you can bunch medical expenses to try to get the deduction that year. But truly, if you're doing medical expenses, it's a rough year. And we probably should be talking anyway to see what else we can do. But medical expenses for most of us are not going to be deductible unless something really bad happens. So if you're taking the time to add up all those prescriptions, add up all those receipts, and it's going to come up to $2,000, chances are you wasted hours of your time and it's not going to do any good. So just want to share that with you. I know a lot of times people bring me in all these receipts of their prescriptions and receipts, and it didn't do them any good. So it has to be more than 7.5% of your adjusted gross income. And then we have to have enough to be more than the standard deductions, which are really high right now. So most likely it won't work, but it might if you had something bad. So talk about that. Let's see. Got a question here. Deadlines for retirement plans. Yes, there are. But the simple is the one that we've already missed. The simples have to be set up by October, I believe it is. That's already passed. You can set it up for 25, but the simple is already over. Most of the other plans, especially now Secure Act 2.0, we can get those set up until the filing deadline. SEP is all the way up until the filing deadline. Solo 401k till the filing deadline. However, even some of the 401ks we can now do up until the filing deadline. That's new as of last year, I believe. But the deferral part has to still be done this year. So if you're somebody, I'm working on a couple of those right now. If you're somebody who we're trying to get a 401k plan set up, we really want to get that done this year so we can get the employee deferral part, because if you're over 50, that's $30,500 that we can deduct this year right off the top. If you're married, that's $60,000 that we can deduct this year right off the top. And if we add that profit share to it, we can do the profit share all the way up until the filing deadline of the tax return, which could be as late as September if we file an extension, and that can be 25% of your salary. So that's a really good opportunity. We got 2-3 weeks left. If you're in a situation where you had a really good year in your business, setting one of these plans up could be wonderful. Simple's too late. 401 could be great. If you were listening to this after 3 weeks, so after January 1st, it may make just as much sense to set up a SEP and then work on the 401k. There is a nice twist with Secure Act 2.0. Used to, you could not have more than one retirement account in 1 year. So what I mean by that, if I had a simple and I made a contribution at all in January, we could not make the switch until the following year. Now with the Secure Act 2.0, we can actually have a simple, and as long as we're upgrading, going to a 401k, if that makes sense, we could still make a switch to a 401k later in the year, and that's something new. We couldn't do that 5 years ago. And so just letting you guys know that. Got another question here. 529 to Roth rollover is limited and users, yes, the 529 rollover is limited. I think I said that a little bit earlier. I believe off the top of my head, it's $50,000. I could be wrong on that, but you can do up to a $50,000 rollover into that 529. And there are age restrictions as well, I believe. If you'll put that down in the comment section, when I get off of here, I can try to actually go into my software and actually look that up and get you specifics, because right now I'm just talking off the cuff. But yes, I think that's a good question, and it's worth being in the comments. I would love to actually answer that for everybody so they would have it. All right, SALT tax. SALT tax, that leads to two different things. One for individuals, SALT tax, which is state and local tax. That happened in the Tax Cuts and Jobs Act of 2018, is capped at $10,000. And that's really a hot topic because our taxes have gotten so high, and especially if you live somewhere like New York or California or places like that. But even here, house values have gone up, and so many clients have hit that limit where you can only deduct $10,000. There's a lot of rumor that could be one of the things that changes next year when they're going through the Tax Cuts and Jobs Act and what's going to sunset. There's a lot of pressure that could be one of the ones that negotiates. I would like to see that because that would help a lot of our clients. Of course, that affects the budget. And if they give us that, that means something else has to go. But this is one that I think there's a real chance it could change, and we'll just have to watch and see. That leads into the business side of it, which is the PTE tax. The PTE tax is pass-through entity tax for mostly your S corps and your partnerships. And what's happened is they're allowed to take a deduction for their state and local tax if they pay it through the entity, the corporation, or the partnership. They can then get a deduction at the federal level on the partnership or the corporation, which gives them a deduction, and then they can get the credit on their personal return. So that works out really well. If the SALT tax gets raised, I have a feeling we won't be doing the PTE tax anymore, depending on what the new limits are. because at that point we could potentially go back to itemizing for most people. And so we'll just have to see how that plays out. But on the PTE tax, from what I've seen generally, I would say really you need to have at least 100,000 in profit before it starts to make sense, because there's a lot of moving pieces. It affects your qualified business income deduction, and there's just not enough savings there to make it worth all the headache if you're below 100,000, in my opinion. It's not set in stone, but that's how I feel about it. It's SALT tax. I think I'm kind of getting close. Annual gift tax exclusions. We talked about that earlier, about the estate tax limits. We think those will probably be okay. But a lot of people are still thinking that the gift tax limit per year is 12,000 or 14,000 or 15,000, and it's actually 18,000. So what that means is if you're married and you're giving to a married couple, so what does this mean? This means, me and my wife want to give money to our daughter and her husband, which I probably just gave her strokes. She's not married yet, but whatever. It's purpose. That's why I'm doing this, to give people strokes. No, not really. But that means we could actually move $72,000 a year from you to somebody else and not have to file a gift tax return. For a lot of us, with a plan like that, if we got 2 or 3 kids, we could actually start moving money and not really have to worry about the state tax, because that's a good chunk of money if you got 3 kids that you could move over several years and get underneath the state tax limits. Now, like right now, the 14 million, most of us don't have a problem. That doesn't mean there'll be 14 million in 5 years. And so we really need to have some good estate tax planning going on. If you're not doing that because you think the 14 million is there forever, I don't know, but chances are it won't be. We're spending money like crazy in this country. Just like I said, the tax rates are at historic lows. They're only going to go up. And I wouldn't be surprised if the estate tax limits have to come down, and we'll have to wait and see, but make sure we're taking advantage of that. Another question: can you open Roth IRA or IRA without earned income? No, you have to have a job. You have to have earned income, and there are income limits there too, but you do have to have earned income. That's a good one. Let's see, what else do I have in here, and I'll come back and see if I got anything else good. All right, that kind of blew through all of that. Bonus depreciation, this is more business. Section 179 property, you can expense up to 1.2 million. That's not most of you. If you bought equipment, it's probably going to qualify. If your income is high enough, we should be talking to your accountant if your income is that high before you start buying equipment. So don't do all this kind of stuff. If you got that kind of income and then come up and expect your accountant to fix it, he can't. So if your income is there, you should have a professional you're working with, not trying to get free advice, for whatever that's worth. Bonus depreciation. If you remember a few years back, we could do 100% bonus depreciation. That's down to 60%. And I believe, it doesn't say that here, I believe next year that drops to 40%. We'll have to wait and see what they do on these sunsets and see if that changes. But for this year, you can do a 60% bonus depreciation. And then, of course, we have Section 179 for anything that has less than 20-year life, I believe it is, 20-year life. So that's going to be leasehold improvements, trucks, equipment, most things like that. Real estate, you cannot deduct in 1 year. Qualified business income deduction, QBI, 20% deduction. You may not know it, but we've been taking it on your tax return anyway, so I won't take much time on that. If you own a small business, you can deduct up to 20% of your profit if all the right things are in place, and that works out really, really well. Someone asked if I could play my guitar. That would definitely be the end of the live stream, and no, I cannot. One last question here, and we'll be getting close to wrapping up. So if there's anything else you wanted to ask, get it in quick, because I'm going to wrap it up. That was just going through those year-end letters and trying to explain it. So the last one was, someone was telling me I can take a large deduction on my rental property by speeding up depreciation. Yes, you can. You have to do a cost seg study. It's not something you can just go do on your own. In my opinion, because of the cost of doing a cost seg study. The place where that starts to make sense is about $500,000 property, maybe 300,000, but generally we kind of start around 500,000 is when that makes sense. And essentially what they're doing is they're doing a study on your property and trying to find all those things that fit within kind of that 20% life like we were talking about, and accelerating the depreciation really fast. If you have the right scenario, a cost seg study can save you a ton of taxes. It can be a great planning strategy. If you've got a warehouse or a building or something like that, and well, here's something. What if you're thinking about selling your building in the next couple of years? What if we did a cost seg study and then we got that big upfront depreciation, got a big deduction, lowered our taxes a ton for the next couple of years, but we knew we're going to sell this property. This is where it can be really cool. You can do that cost seg study now, get the big deduction. Got to be careful there because there are some snafus. Don't just go do this without talking to somebody. But then we 1031 exchange it into another building, or there's some really cool things out there now in the investment world where you could take that building, sell it, take all that gain and roll it into a DST, a Delaware Trust, which for most people, the easiest way to think about that is kind of like a REIT or a investment where a bunch of us come together and buy a really nice apartment complex in the Southeast or the Southwest, somewhere where it's going to grow, it's going to be safe, it's going to do well. But we could take all that gain, roll it over there. We got the big tax deduction now. We're going to roll all that gain into this DST. It's a part of our estate plan. Then when we die, our kid inherits this DST. They get a step up in basis. We got an income stream because that DST is going to be kicking out rental income. Basically, it's not quite that simple, but basically kicking us out, 4, 5, 6% a year in return on our investment. So we have an income stream without all the headache of managing, and then our kids inherit it tax-free. Or there's even one that's even cooler now, where you could do all those same things, but after 3 years, a REIT has agreed to buy your Delaware Trust. It rolls into that REIT, and now you can start pulling the basis back out tax-free and leaving the gain in there until you want to, or your kids inherit it. Really cool stuff. If you have a large building, over $500,000, and you've depreciated it, or there's something like this, you may want to call me on that, because there's a real opportunity there for you to really save some taxes and pass that on to your kids in a very tax efficient manner. Meanwhile, continuing to have an income stream during your retirement years with no management headache. I mean, they can be awesome. So that was actually a really good question. I don't know, I kind of went with that, but I like that one. So I think that's it. Does anybody else have anything else before we wrap up? If you're watching this later, if we put it online, leave comments. I'll try to answer them, because like I said, I'm not going to have time for many more tax appointments with people that aren't on a subscription basis with me already, or my calendar's already full. So last chance. If not, we will wrap it up, giving it about 10 seconds. Guys for coming, and hopefully it was helpful, and we'll see you during tax season.